Let's now take a look at how global markets performed this past week. U.S. stocks closed this week with mixed results as investors reacted to economic data and prepared for potential shifts in Federal Reserve policy. The S&P 500 closed marginally higher this week, and that's strengthened by positive consumer sentiment figures and reassuring inflation data. The Nasdaq Composite also posted gains driven by continued enthusiasm in technology stocks amid ongoing AI advancements. Meanwhile, the Dow Jones Industrial Average ended slightly lower, reflecting broader market caution. European markets struggled with the pan-European stock 600 ending the week lower. Concerns over economic growth and inflation persisted despite inflation reports from key economies. France saw a slight slowdown in inflation. In contrast, Spain and Italy reported mixed inflation figures, reflecting the ongoing economic challenges in the region. While Asian markets showed resilience, buoyed by upbeat economic data from Japan. Japan's Nikkei 225 rebounded to a 34 high, driven by strong industrial production and Tokyo inflation exceeding expectations. South Korea also saw improvements in retail sales despite continued economic pressures. Hong Kong and mainland China markets closed higher. Although geopolitical tensions and economic uncertainties remained the focal point. Oil prices surged amid escalating tensions in West Asia, which raised concerns about potential disruptions to global crude supplies. U.S. crude and Brent crude both recorded gains, with U.S. oil briefly touching its highest levels since April. Well, all these risks underscored fluctuations in energy markets and heightened investor caution. Gold prices steadied as the latest U.S. inflation data aligned with expectations, bolstering hopes of forthcoming Fed rate cuts. Spot gold closed steady, supported by declining U.S. Treasury yields and ongoing market speculation. Silver and platinum also saw modest gains, reflecting broader interest in precious metals as safe haven assets amid economic uncertainties. Well, looking ahead, investors will closely monitor ongoing issues related to inflation, particularly in the U.S. and Europe, to gauge further Fed and ECB policy decisions. And well, to help us understand the outlook for global stocks, we have with us today on the show Professor Vikas Singh. He is an author and columnist joining us from Hyderabad. Welcome to the show, Professor Singh.
Good morning, Aim, and good morning to all the viewers.
Good morning, Professor Singh. I want to first start by asking you, what are the factors that have led the rally in the first half of 2024?
There are several factors which are credited with contributing to the global stock market rally of 2024. Let's start with the first one, shifting Fed policy. In 2022, when the Federal Reserve raised interest rates to combat inflation, this initially spooked the investors as higher borrowing costs can slow economic growth. However, this year the Fed's stance has softened. They have hinted at potentially reversing rates. And this has made the investors more optimistic about the future economic conditions, leading them to buy stocks further. The second reason is that investors' confidence in the rate cut has increased. The Federal Reserve's signal of potential interest rates cut later this year has cheered the investor sentiment. This means that investors are anticipating cheaper borrowing costs, which can stimulate economic activity and make the stocks market even more attractive. Thirdly, the return of the retail investors. After a period of selling in 2022 and to a certain extent in 2022-23, retail investors are returning to the market, injecting fresh capital. This increased demand is pushing stock prices higher. So liquidity has contributed to the growth of the stock market. Even though the Fed is tightening monetary policy, other sources of money are flowing into the market. Banks, money market funds, and the leftover of the government stimulus during the COVID time is keeping the financial conditions relatively loose. However, this easy money supply may not last forever. Lastly, there's a tug-of between value and growth. The rally is interesting because it's encompassing both the value stocks, that is established companies with stable earnings, and growth stocks. Companies with higher potential. In 2023, investors were cautious, but with the potential economic slowdown seemingly avoided, value stocks in sectors like financials and industries are recovering. At the same time, the 2023 recovery is also reviving growth stocks, particularly those in high growth areas like artificial intelligence and technologies.
Right, Professor Singh, just for better
But
understanding, right, I was asking that if a correction on the cards for some stocks, is there a correction on the cards for some stocks, mostly the tech pack on Wall Street?
correction can happen. This is a market and markets can fluctuate. However, I don't see much of a correction going forward. If you really look at the stock market, this has been going up because the global conditions are getting better. Europe escaped recession last year and is now on the verge of returning to growth. Similarly, China, which did very, very badly over the last 2 or 3 years, now we can see some green shoots of the growth in the Chinese economy. Though the best days of China is over and is behind us, similarly, Australia is also picking up. But above all, I think the Indian growth story is really the story that the world is looking at, and it is leading the growth across the world. I don't see too much of correction in 2024 across the world, with a bit of caution because most of the large economies are going to the polls. We will have to wait and watch what's going to happen in the U.S. economy, who comes to power. Similarly, France and UK are due for election very, very soon. So that may be the joker in the pack. But as far as growth is concerned, I think the world economy is doing fairly well. And I don't see too much of a danger. Viewers must not forget that the economy has remained, the global world economy has remained fairly stable in spite of several wars and several skirmishes across the world. So we are here. 2024 and 2024 looks to be better than 2022 and 2023.
Right, Professor Singh, you spoke about the Indian market here. Just to follow up on that, will emerging markets like India continue to gain even if the Fed delays its rate cuts? What's your assessment on that?
I think the Indian market is, unlike what used to happen 5 to 10 years ago, is now largely detached from what's happening across the world or foreign investors' flow. Viewers will appreciate that close to about 20,000 crores is injected into the Indian stock market by retail investors through SIP and other means. That has kept the liquidity very strong. Secondly, investors across the world, particularly in India, also realize that India's growth story is fundamentally very, very strong. Our organizations are doing well. We can see larger organizations, the blue chip stocks, their growth growing by about 10 to 15%. So with a growth like this, people are lapping up these strong companies and these blue chip companies. However, I would like to say that I can see some bubble in micro caps and in some sectors of the small cap market. And our viewers must be careful. They must look at fundamentally strong organizations, fundamentally strong companies to invest in. The lazy money days are over. I think only the strong and fundamentally stronger organizations will make money for them.
Right, Professor Singh, thank you so much for taking out time and joining us here on World Business Watch with your insights.
Thank you so much for having me here. Have a good day.